Modern Warren Buffett Stocks. This is StockerFinance, and I'm your host, David Scheuer. So this all stems from a comment on Reddit I got, and it comes from GWhite9. So the comment is, what are some of the new best Warren Buffett type strategy companies out there? I'm not talking Coke or Disney, but maybe something that's gone public in the last 5 to 10 years. I'm not asking anyone to do research for me, just wondering what your opinions were. So before we talk about what Warren Buffett type strategy companies are, let's talk about what the Warren Buffett type stock and strategy is. And it really all revolves around the value investing strategy. So here's the dictionary definition of value investing. Value investing is an investment strategy that revolves around picking stock that appear to be trading for less than their intrinsic or book value. Now, intrinsic or book value is basically just a value that you think something is worth or that it actually is worth. So basically, you're picking stocks that you think are at a discounted price and that are actually worth more than what they're currently priced in at. So, for example, stocks that Warren Buffett might pick are stocks that have extremely strong balance sheets. They're profitable, they don't have too much debt, lots of cash on hand, etc. They preferably offer dividends, stocks that pay dividends allowed for a passive income, as well as for you to buy more and compound on that investment. They're adaptable and can withstand market uncertainty. So perhaps they're very old companies that have been around for a while. They've been through recessions, depressions. They don't mind market volatility. And in the long run, they're on a steady trend to grow, or they're pretty stable companies and you're just receiving this dividend as your return on investment. And they're stocks that you can comfortably hold on to, as I said, for long periods of time. So typically a Warren Buffett type stock is one that is long, steady growth. You're not really looking at short-term moves here. This isn't day trading or swing trading. This is long-term, 2, 5+ years. Maybe you might never even sell this stock. There's plenty of stocks that Warren Buffett has never sold because he's so comfortable just holding and receiving those large dividends. All right, so Warren Buffett's most famous holdings. Let's talk about this because the title of this video is Modern Warren Buffett Stocks, stocks that are more modern and have IPO'd more recently. And so when you look at Warren Buffett's most famous holdings, it's Bank of America, which is 1978, Coca-Cola, Kraft Heinz, and Heinz and IPO actually merged. So Kraft IPO is actually a newer stock, but it merged with a very old company, Heinz, and they merged in 2015. Now, all these companies are pretty old, as in they're all founded in the 1900s, around there, and a lot of the stocks that I'm going to talk about also did. However, all these IPO'd very late. Or, I mean, not very late, very early. And a lot of the stocks we're going to talk about have IPO'd later on, some more recently. So, as you can tell, the average company age here, or the average age of their IPO is very old. And that's why the person who asked this question was talking about, hey, what are some more modern picks that I could choose from? And a lot of people have been wondering that as well. So, modern Warren Buffett type companies. A company that has IPO'd in the last 5 to 10 years. This is just kind of some rules I'm going to put around it. A company that meets Warren Buffett's style of investing. So, as I said, value investing strategy, dividends, good balance sheets. It's a profitable and growing company, hopefully. Its current stock price is at a discount, and the company can withstand an economic instability. So, as long as it meets a few of these, doesn't necessarily have to meet all of them, but as long as it meets a few of these, we're going to consider that a modern Warren Buffett company and a company that perhaps Warren Buffett would like to invest in. So, our first one here, we're just going to hop right into it, is Visa. It IPO'd in 2008. And Visa is a financial service and processing company. Cash is disappearing more and more, and Visa and MasterCard both lead the way and have been increasingly adaptive and profitable companies that also pay dividends. So its market cap is $355 billion. This is a large company. It's been around for a while. They know what they're doing. It's really settled in place here. Its 52-week high was $214.17, and its current stock price is $165.57 as of today. So as you can tell, it's significantly lower than its 52-week high. Now, we don't know necessarily if that means it's undervalued, but we do know that the stock price is very cheap compared to its 52-week high. And that's what you're going to see with a lot of these companies because of this, coronavirus correction that we're in right now to the market. Now, its dividend yield is 0.72%, which isn't very good compared to a lot of other companies' dividends, but it is a dividend. At least it offers one. So you're getting something out of it, and its stock price is very cheap right now for what the company is. So the next one is, as you might assume, is MasterCard. MasterCard IPO'd in 2006, around the same time as Visa, and pretty much the same reasons as Visa in terms of describing the company. Visa and MasterCard also don't hold the risk of people defaulting on payments. They're not a bank. They don't actually give out the loans. They don't give out they're not the ones dealing with credit card payments. They're the ones dealing with the transaction. So they take fees off transactions. They're not giving out money that someone has to pay the loan on. Someone could just not pay their credit card off. This really won't affect Visa and MasterCard. Its market cap, $251.8 billion. Its 52-week high is 347.25 cents. and its current stock price 253.25 as of today. Also has a very small dividend, even less than Visa's, but its current stock price is again is significantly less than its 52-week high. And, this might be because business transactions are down right now, so they're not receiving as many fees. However, online transactions are probably significantly up, and people still pay a lot of the times with the Visa or MasterCard online. So, in my opinion, these stocks are significantly cheap from what they are, and they've actually rebounded from their 52-week low, which was actually about $100 or $50 less than what the prices are. And these two stocks really follow each other in terms of their price pattern. So, next one is Discover. A little bit different than Visa and MasterCard, but I think this still falls into the same categories of a Warren Buffett stock that you might invest in, although it's a little more risky because it does actually give out credit card loans, etc., that people could default on. And as of right now, people might be short on money. It's pretty likely that people are going to default on their credit card payments, not be able to pay it off. They're going to accrue a lot of interest, and the bank might get a little screwed over. So it is a little risky right now, I think, for a lot of these lending companies, mortgage companies, etc. Now, Discover's a much smaller company compared to the other two. Its market cap's only $11.51 billion. 52-week high, $92.80, so its stock is much cheaper as well. Its current stock price is $37.95, way lower than its 52-week high. However, the nice thing about Discover, and this is the part that I think Warren Buffett himself would appreciate about this company, is that it does have a nice dividend yield. It's much higher than Visa and MasterCard, and it also has a lot of room to grow. It's only worth $11.51 billion, whereas Visa and MasterCard are worth significantly more. However, Discover is a much different company than Visa and MasterCard at its core. In my opinion, it carries a little more risk. However, it may be currently undervalued as well. All right, number 4, Facebook. Now, this one, most of you might be saying, wow, this seems like an older company, but it actually IPO'd in 2012, fairly recently. And it's one of the most powerful, it says power fee right there, it's supposed to say powerful. It's one of the most powerful companies in the world now. I think that's a no-brainer. It's still growing in users and revenue. It'll most likely continue to dominate social media with Instagram and Facebook. And it doesn't offer a dividend right now, which Warren Buffett really wouldn't appreciate. But I wouldn't be surprised if they offer that in the future, as it's kind of steadying out right now. Its growth has really steadied out the last couple of years. And I think investors are going to put pressure on them as their growth slows down for them to start offering a dividend, because once growth slows down, investors still want to receive something out of that. They still want to receive some sort of payment if it's not growing at a really rapid rate, and so they could receive pressure to release a dividend. And I've been doing some research on that. There's some people saying it's going to be in 2020. Some people thought 2019. So who knows? They could not release one at all. But as its market cap, it's a very large, stable company. It's not going to go around anywhere, which it's profitable. Its 52-week high was 224, and its current stock price is 165.95. And again, doesn't offer a dividend. But yeah, so this stock price being significantly less than 52-week high, and it being a very stable company that's going to stick around for years to come, this is a stock that Warren Buffett or a value investor may look at and say, you know what? Is the coronavirus really infecting Facebook that much? Why is the stock price down so much from its 52-week high? I mean, people are going to be using the internet more and more. They're going to want to connect with friends. That means they're going to be on social media more and more. So as far as I'm concerned, I wouldn't be surprised if users and if usage really increases to Facebook and Instagram as well, which Facebook owns. So for its stock price to be this low, in my opinion, seems a little undervalued, and perhaps it's at a discounted price, which someone like Warren Buffett would love to scoop up, even though it doesn't offer a dividend yield. Next one, Delta Airlines, IPO 2007. Now, this is a company that Warren Buffett actually added more to his position. So he actually owns the stock, and he recently added more to it, and that's kind of why I threw it on. Now, obviously, airline stocks are kind of sketchy to invest in, and right now they're just getting hit hard. However, does that mean there's an opportunity? They're getting this massive stimulus package that's really going to support the airline industry. And so even though they're being hurt significantly right now, perhaps the stock may be considered cheap for a company that both offers a very nice dividend at 5.62% and that has proven its adaptability in the marketplace. It's been around for a little bit now. And it's also, it's not a huge company in terms of market cap, 18.35 billion. That's less than pretty much all the other companies on this list so far. Its 52-week high 63.44, current stock price 28.67 as of today. And that's a significant difference from its 52-week high. That's a lot lower of a stock price, and its dividend is very nice. So the thing is, there's a chance that this company could cut its dividend. In fact, I wouldn't be surprised if it does. And they've kind of seemed like the stimulus package was encouraging in a way to cut their dividends as long as they didn't lay any more people off. Or I think it was as long as they don't lay off more than 10% of their workforce. So they could save money on the dividend, which will help them in the long run, but not paying a dividend as a value investor, it's not what you want to see at all. Boeing recently cut their dividends, so I wouldn't be surprised if Delta Airlines follows that as well as other just people in the aerospace industry, airlines, etc. So I think I put this on here because Warren Buffett is buying it up, and it's very cheap right now, and I think it probably is undervalued in the long run. And if you know Warren Buffett, he's probably looking 5 years out from now. And so if you look that long out from now, this could be a great buy. And if it brings its dividend yield back, or if it keeps it, then this is a cheap company at 18. It's not cheap, I wouldn't say, but it's less than the other companies we've seen on this list, which means there's opportunity for it to grow potentially. Personally, I actually don't know too much about the airline space. I'm not really invested in many airline companies, haven't done too much research there. So if you know more about it, let me know. But I think this does deserve to be on this list just because Warren Buffett is adding more to his position, and it IPO'd in 2007. Next one, Netflix. So Netflix is an interesting one here. IPO'd in 2002. It has lots of competitors right now, and people think that the stock still may be high. There's a lot of analysts who have an average price target of 150. Now it's 52-week high, and its current stock price is 370.96. So it's about a lot higher than what analysts think. Now, analysts' opinions pretty much mean absolutely nothing. They're just people speculating just like us. And they're just making guesses. However, their guesses tend to have more weight since it's documented and they have licensing, which also pretty much means nothing since a lot of these analysts are wrong all the time. Anyways, it's still a profitable company, maintained and grown its users despite competition from Disney and others. I really thought Disney and Amazon Video and a lot of these just wiped Netflix out. They have so much content. Disney is such a huge fan base, and they offered better prices and a better package than Netflix. I mean, I had Disney Plus, ESPN Plus, Hulu as well, and so I thought Netflix was really going to get wiped out, but I was wrong there. Netflix has stuck around, and in fact, they found this niche market of releasing these sort of documentaries. If you've seen Tiger King, it's super popular, and they keep doing that with different shows. They keep releasing these unique shows that you can't find anywhere else, and the only place you can watch them is on Netflix. And it creates this sort of following, this cult following around Netflix that keeps users coming back because the only place they can get that content is here. You can watch Disney movies on places other than Disney Plus. And that's something that maybe if you don't want to pay the monthly fee, you just rent the Disney movie on demand or something like that. Or you find the Disney movies on YouTube, etc. So, and Disney does have The Mandalorian, but I think a lot of people just canceled their subscription after The Mandalorian. However, Disney Plus is still growing. But Netflix, it has this niche market, and we're going to see how they do. I think I'm actually going to make a video about how I think Netflix could stick around and really be a threat to Disney and other competitors in the future and how they could add more revenue, but we're going to save that for a different video. Anyways, its market cap, $162.78 billion. As I said, 52-week high, 392.52. And its current stock price is 370.96 as of today. So unlike the rest of these companies, its stock price isn't really considered that cheap compared to its 52-week high. In fact, it's actually performing very well during this market downturn, especially because, people are using the internet more. And that's why I think it's interesting that Facebook is down so much, because Facebook, it's an online company. People are using the internet more. They want to connect with friends. So Facebook to me seems very cheap, especially since Netflix stock really hasn't taken much of a hit. Now, it doesn't pay a dividend, which as a value investor, Warren Buffett would not like. So would he invest in this company? It's questionable. If they started offering a dividend, I think they absolutely will, since it's been around and is a profitable company. But we'll see how they do in the future. As I said right here, as I kind of forgot I wrote this, if Netflix can take advantage of merchandise sales and integrate other forms of revenue generators into its platform, I think it'll be able to be around for a long time. And I'm going to talk about that more in another video, so stay tuned. Make sure to subscribe. All right, number 7 here, and I believe this is the last one. I only really got 7 on here. Alibaba. So Alibaba, similar to Amazon, it's the Chinese version of Amazon. And it has lots of products that are sourced through Alibaba. So Amazon sources a lot of its products through Alibaba. There's a lot of drop shipping people that go directly through Alibaba and AliExpress, etc. And then they sell these products and relabel them in the US. And so it's kind of a wholesale company in a way, but it also has a Amazon site. And it's profitable, has little debt. It's interconnected with the Chinese government, of course, which means it's going to be around for a long time if it's interconnected with the Chinese government. There's no dividend as of right now, but I wouldn't be surprised after growth slows down, if it slows down, that they will offer one. Now, the interesting thing that I see here, Amazon is worth almost double Alibaba's market cap. So market cap for Alibaba is 513 billion. And the reason I didn't put Amazon on here is because its IPO was more than 5 to 10 years ago. So I tried to put not newer companies necessarily, but companies that have more recently IPO'd. Anyways, so its current stock price 191.27, and that's purely because of the coronavirus outbreak. I don't think there's really any other reason for their stock to be this low compared to its 52-week high. So is it cheap right now? If you look 5 years from now or plus, probably. In fact, I think so. Obviously, I'm not a financial advisor or analyst. I can't really tell you to buy it or not, and I'm not going to. This is entertainment purposes only. But, its stock price is significantly lower than its 52-week high for a company who, it sells things online. If more people are going to be staying at home, perhaps more people will be buying stuff online. And on top of that, the Chinese curve for coronavirus cases, they've really taken control there. It's obviously an authoritarian regime, so they've probably been able to do that a little more effectively and a little more harshly in terms of controlling the virus. But that also means that their factories are going to be up and running, and Alibaba will get going again into full production and full sales, etc. So Alibaba, again, is similar to Amazon, is growing quickly. Amazon is currently worth double Alibaba, so perhaps Alibaba is still undervalued. Anyways, guys, thanks for watching. Please subscribe and like. It really helps and supports this channel if you subscribe. I'm going to have some great content out. I'm stuck at home, so I'm going to have some great content out coming soon, and likes just help the YouTube algorithm. Again, we're going to have the book of the week, so every week I read a book. This motivates me to read, and I think it could motivate some of you to read more books as well, for just financial and business books. And I'm going to review one at the end of every week. So that'll be at the end of next episode, which should come out probably around Thursday. Maybe we'll have a Wednesday episode as well. So we'll see if I do 2 or 3 episodes a week. We're going to find out. Anyways, make sure to check out these videos as well. This is StockerFinance. I'm your host, David Scheuer, and I'll see you in the next video. Thank you for watching.